Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 14th, 2017. It's a little after 10 o'clock Eastern Time, so the markets are now trading. We're about 40 minutes into the trading session, and I wanted to do just a quick overview of the U.S. equity markets as well as some of the other major asset classes that really come into play at this point in time. Now, most of you guys know the big thing that we're waiting for here is the Fed announcement tomorrow. Some Fed meetings are more significant than others, and let me just pause this video and pull something up real quick. Okay, this is the trading room for those of you that are either gold members, free trial members. Pay attention every now and then. You'll always notice this site-wide notice bar up here on the top of the sidebar within the trading room. And yesterday I put up a note. Once in a while, these are called all member notices or site-wide notices I'll put up. And I just wanted for those of you who followed the site for years, you've heard me say this dozens of times. Some FOMC meetings are what they call lame duck meetings. There's nothing expected. It's almost a near certainty, especially in recent years. The Fed has done such a job of trying to manage expectations, talking the market up, talking the market down. And point being that some meetings, there's not going to be any changes to the FOMC policy, and sure, the market might move a little based on what they say, what their outlook is, but this this one has a potential to move the markets with a good chance of a rate hike. So I put a little note here, and you can click that to dismiss it, that trading volumes tend to taper off, and just be careful because there tends to be an increase, from my experience, in whipsaw signals. About the only certainty is we'll see some sharp volatility at 2 o'clock Eastern Time tomorrow. Here's a countdown clock I put up in there yesterday. So at 2 p.m. Eastern Time, we'll get the decision. And just remember that the market's initial reaction, whether it rips up or rips down, sells off real quickly, very often isn't the reaction that sticks. In fact, it's not unusual to see the market rip up and then turn around and fall very sharply. You really have to I refer to that as post FOMC noise. Just the high frequency trading machines take over. Traders are positioning. Things go crazy. Point being that I don't jump the gun on breakouts in the days leading up to it. I did put on Cocoa as a long trade idea yesterday. And that's also a very, very little, if any, correlation to the broad markets. But as far as regular equities that trade in line with the broad markets go, and other things that might be affected by tomorrow's decision, such as gold and things like that, be a little careful. I try to be a little selective on breakouts, that's all. So just kind of an FYI there. All right, now let's take a look at the markets and those other things. We'll look at the U.S. equity markets. We'll look at oil, gold, and bonds real quick. This is the bigger picture. I've talked on it many times. This isn't the most valid or most important trend line because there's only a couple. We really don't even have a third reaction yet. Well, we have two reactions right here, one there. But that's one trend line I'm waiting to see go on the SPY. Bigger picture just shows a series of clear divergences that have been building, and some of the most overbought readings that we've had in decades, if not longer, on the U.S. equity markets. So that's the SPY daily chart. Here's the SPY 60-minute chart. It's been a slow grind. I know I've been beating the bearish drum for quite a while now. And it's not really as if the market's gone anywhere, at least not for a while here. You can see we popped up, made another new high, and we're back down to where we were. When was this? That was back almost a month ago. So if I go back here, this is, here's where we were February 17th, and we're about back down there now. Now the technicals, again, clearly to me, I don't see anything in the charts that give me pause on my bearish, my call for some more downside. But let's see what happens tomorrow. Again, the FOMC, I've made it no secret that I have short exposure. I've had for a few weeks now, and plenty of room to add. And I'll wait till the announcements out of the way tomorrow and the post FOMC noise settles down. But as of now, things look pretty bearish. But again, don't read too much into today's price action because it is just maybe some nervous jitters. Maybe people, we've had a big run up. I'm sure there's probably people that want to take profits in front of the FOMC announcement tomorrow. So there's a SPY. That purple trend line you can see, I should have clarified that, has been broken and back tested. I didn't really spend a lot of time here. And I'm still looking for a move down to at least this yellow uptrend line right here. That goes back to the left of this chart quite a ways. You can see the negative divergences. So that would be, just to try to quantify it from current levels, I'm just going laterally here. That's about another, from where we are now, call it 2% drop if we got there tomorrow. And that's, again, minimum target. We'll see if how things play out. Most likely will extend those targets. We don't have the SPY as an official trade. Here's QQQ. This one I am short personally, and if I'm not mistaken, there's still an active short trade on the site on this one now. There's the uptrend line, rising wedge, breakdown, back test. We're gradually rolling over, but again, even though we're down today, I don't expect fireworks in front of the FOMC meeting, but afterwards, very likely. So these are my targets, at least a move down to this purple uptrend line. I had an asterisk here before because at the time, if we would have broken down earlier, that the purple uptrend line and this level came in together. So right now, let's just say my minimum expectation would be a move down for the 124 area in the Qs, and that could come pretty swift. From periods of low volatility like this, Bollinger Band's pinch, the VIX is at a low. I would not be surprised to see a waterfall rush for the exits. But we'll take it as it comes. These are the levels that you can trade off of if you want to just game a shallow pullback, or if you're bullish and you want to buy the dip. There's the support levels. S1, support 1, 127.50-ish. T1, which is my second target, unadjusted, that's the actual support level, 126.10. Scale in, buy at these levels if you think the market's going off to new highs. And if not, I'll be looking, for a swing short down to at least these levels. And depending on how things look, I may, extend short the Q. As far as broad markets go, short the Qs and IWM via a couple instruments there. So let's take a look at IWM. That one's down pretty nice today. That's down about 1%. So that's a story on this one. We had a sideways trading range that went on from early December. We had what I call failed breakout bull trap, this little red shaded area here. We broke above the trading range. That breakout occurred on a divergent high, actually two different divergent highs. We had one, pushed us back down, really tested the top of the range, pushed up, made another marginal new high. This is very bearish in my opinion. The bulls had cleared that level and couldn't sustain it. They're just, you can say the bulls, the bears, whatever you want. Markets are really just supply-demand dynamics. That's all it is. You have essentially at some point the buyers dry up, at least for a period of time, and then you have more sellers than buyers, and I think that's what's happened here. So just that breakout, and the charts again indicated that breakout wouldn't be a breakout and then run on to new highs, as sometimes you get after a period of consolidation. Instead, we had a failed breakout. The IWM small caps are down impulsively, and if you look at this, it's possibly a bear flag continuation pattern right here. If I draw that out, this being your flagpole, the move down, an impulsive move down. And so far, a very impulsive breakdown today. You can see the big red candle right here. And the way that would play out is it would look something like this. You take the length of the flagpole, you add that to the top of the bear flag, and that would take us down. I just drew it. I didn't take a parallel line. That's usually what I do, and that would take us, call it down to roughly my 132 target. And again, we'll just have to look at the longer term charts. I posted this yesterday, an update of IWM. There's a lot on this chart. Agree, it's busy, but the things that stand out to me are the recent extreme overbought conditions. And although that didn't trigger correction, that's not unusual. We also had a divergent high. So sometimes you have these high level, we had some small divergences there. It did play out for a correction, more so in time than in price. Markets managed to make a marginal new high, but with very steep divergences in place. You can see the negative divergences at that high. bearish rising wedge, which broke down. And then yesterday at the highs, right when we were back testing that line, I posted that as the IWM was back testing resistance. That's a very well-defined downtrend line. Look at all the levels. And then when prices broke above it, it acted as support, as it should. It acted again as support here, finally broke down, back test. That's an objective short entry right there. And so far you'd be up 1.21%, which on TF, that's about $900 when you get a 1.2% drop on TF. So not a bad. TF is the E-mini futures for those of you that trade that. All right, that's the IWM. Those are the broad markets. I think I covered most everything. And let's look at crude oil. I posted an update in the trading room today. There's a decent support level here, at least on the charts of USO. Now, USO, sometimes you get the case of the tail wagging the dog. Some of these ETFs, such as GLD, are so big that in the past, if you wanted to trade them when they were relatively new, you really had to watch the underlying. You had to watch the price of gold, spot gold, gold futures, crude oil. Now, these ETFs are getting so large, inflows and outflows can affect the price of the underlying commodity. And so I think you can trade USO, you can trade crude somewhat effectively. Now, personally, I like to watch the charts. CL, those are crude futures, WTIC, continuous contract. All the different various vehicles to trade crude or that track crude oil. But I mentioned this is about another almost 2.5% downside to this 984, 985 level. There's some decent support, as you can see there. Although the big number, I've had people asking me for months, Randy, what's your opinion on crude? And I made clear I don't have one. We were in a sideways trading range. And until that thing broke, you wouldn't have any really good idea which way crude was going. However, I did make mention it broke down very impulsively the other day. I had some inquiries, not just about crude, but about some of the big energy stocks, and I said I wouldn't touch them. This huge, look at the size of that candlestick. That's what I pointed out. That is about as impulsive as it gets. That's the definition of impulsive, an impulsive move right there. And it was a break down below this multi-month trading range. So you cannot spin that any other way but bearish. And, and that's not, you don't get a one-day move. When you have a multi-month sideways trading range, as you see, there has been nothing but follow-up selling, all those red candles. So if that was your sign, if you were long gold, if you're long the energy stocks, at least in my opinion, I would have exited on that. And again, I made very clear I had no intention. I stayed clear of crude when it was in a trading range. And could you have shorted then? I didn't short it. You probably could have because there was follow through downside, but it was such a big move down. You would have had to really catch it on early. But either way, that changes the near-term outlook. It puts, that's a bearish breakdown, and it opens the door for a move down here to 984, 985, call it, and possibly another 10% downside on around to the 908, 910 level on USO. Let me correlate that with the charts of WTIC. Let me pull those up here. Okay, this is WTIC, like crude oil, continuous contract. This is an end-of-day chart, so this doesn't reflect today's trading. All these are notes I had. I've posted this chart in the past. Way back here when it hit that level, I posted the $50 level has been a ceiling on crude prices for years, and you can see we just bounced around, give or take within a few percentage points. That proved to be a ceiling, and that was the top of that trading range I talked about. Here was an uptrend line. There's that impulsive breakdown. So we broke both below the range. I showed on USO we had this wedge pattern. You can see the negative divergence down here on both the RSI and the MACD. So not only was that breakdown foreshadowed, again, I didn't have the confidence to trade it. I'd rather, if I don't have a very strong opinion, I'll stand aside on something. And I did on crude this time around. But what I see here, there was a support level here, a long-standing level around 50. That's already been taken out. And I did a measured move. Although I showed you about another 2.5% or so downside on USO, and then I also showed you better support around a 10% drop. That aligns here with this chart. Based on the scope of these negative divergences, that impulsive breakdown, I don't expect it to be a straight down shot, but I do see the possibility, or let me spin this another way. I don't see a whole lot of strong support on crude until we get down here to that looks to be about $43 level, and that's about another 10% drop on crude. Whether we get there or not, again, I mentioned some decent support, about another 2.5% lower. You can see it better on USO, but that wouldn't bode well for the energy sector, most certainly. You know, your Exxon Mobil's, Chevron Texaco's, Chevrons of the world, and other energy stocks like that. So just keep in mind, until the charts show us otherwise, I'm leaning towards more downside in the coming weeks to possibly months on crude, possibly as much as a 10% drop. And we'll go from there. All right, that's crude oil. Let's get back to this charting platform here, and we'll just take a look at gold. I have questions almost on a daily basis on gold. Gold is starting to firm up. A couple things I like. We're starting out here on a daily chart. 113.95, call it 114. Looks like a pretty decent support level. Let's see how close we came just the other day. We hit a low of 114.13. So there it is, close enough. You can see, what am I looking at? Well, I have a big gap right here, number one. Love gaps. Gaps often are significant technical levels. You go to the left, you had some gaps on both sides of this cluster of candles. So it's a decent support level. The PPO is still in bullish territory. See the white line? I wait for the latter of the two to cross. When the white line, which is the 9 EMA, and you'll see this if you put up a MACD, it'll look very similar. When the signal line, that 9 EMA, is above the 0 line, the trend is bullish, and it's been above since this point right here. Let's mark these up for you. We had a bullish cross here. You can see how well that level often acts as support or resistance when tested from above or below. So there was a level. The trend was bearish all the way back here is when we had a cross. The trend has been bearish since then. We tested it there, but it remained on a sell signal. At least this one indicator became bullish there, and it's still bullish. And unless we have a crossover again of the latter of the two, which would be the white line, the 9 EMA. So other than this brief, we had a brief whipsaw signal here. You know, it told you the trend was bullish all the way from here to here. And as you can see, that, you know, kept you long. Sorry, guys, I grabbed the wrong tool. I was trying to grab the arrow tool. So there it is. I don't know what's wrong with the screen grab software. Let's see. Try that one more time. I click on the arrow. Here it is. Finally got it. There it is. So you can see pretty effective trend indicator. Bearish cross, bearish trend. Bullish cross, bullish trend so far. So that's the daily chart. One of many indicators. There's other things out there. We look at the 60-minute charts. I've been, made this very clear all along. We were working our way up within this bearish rising wedge. Before it even broke, I put it up. This chart, purple trend line, defines the bottom of a potentially larger wedge. Either way, a break or close below this trend line would be bearish. That was posted somewhere up in here. We broke down. There's a measured move for the wedge. So we haven't hit the measured move. I mentioned 113.95, the 114-ish area being okay. I don't see a lot on this 60-minute chart that makes me want to step in yet. I like to see bullish divergence. I don't see that yet. We don't have to have that to reverse, but if we did get down here to that 113 area, that would be the measured target for this rising wedge. It has the potential to put in some bullish divergence if we dip down, get some positive divergence there, as well as the RSI. You see something like that. I'm just drawing out these divergences. I think you guys can follow that. We might have a downtrend line to watch here as well. That would provide additional confirmation, a breakout above that downtrend line. So that would be an ideal scenario. You don't always get what you want, but that's something I'm on the lookout for. So maybe that move down to 113 there. And if we reverse before then, because again, tomorrow, whatever the Fed does or says has the definitely has the potential to cause a big move in the dollar. And as you guys know, gold is largely driven in part by the price of the U.S. dollar. So anyways, some things to be on lookout for. I would certainly not be short gold at this point. At least I have no desire to be. Who knows? Gold could drop another 10, 20% for all I know. But at this point, I'm waiting patiently for an objective long entry, and I won't even go into the miners. Well, you know what? Everybody asks, so I'll go ahead and do that for you guys. I get so many inquiries. There's GDX. I don't see a lot right here on GDX chart, but when I look at some of the big components, the big miners like Ape, Barrick, the longer-term charts still look bullish. Newmont, I had a couple of these recently coming down to support levels. There it is, GG hitting a support level, FNV. I also should have covered the weekly chart on GLD, guys. That's the bigger picture, and I never did that. I'm jumping all over the place here. This was the bigger picture on gold. We had bullish divergences in place, right? And we still do. Well, we had bullish divergence right here at the low. That was where the bullish divergences were. I should clean that up and make that very clear. These lines don't need to be extended. That was our divergent low at that multi-year support zone, which I had that as a target for quite a while in gold. And we had this well-defined downtrend line, this sort of wedge type pattern breakout, and we just recently back tested. So from a longer term perspective, gold still looks good. And that's gold. So we'll leave it alone there. I give you some potential buy targets. These are all additional support levels here. So I think gold is getting close. Now let's look at bonds real quick. Bonds tell you a lot about the stock market. My guess on TLT, this is a daily chart. It looks like, and I made mention in the trading room yesterday, I think we're setting up for a reversal in treasury bonds. TLT tracks, it's the long-term treasury bond fund. So these are bond prices, and they move inverse to rates. So TLT, you had a reaction low back here in 2015. What I see as the most likely scenario is just a little more downside, either to those lows, maybe slightly below those lows. I sort of favor an undercut, a slight undercut of those lows, then a reversal. And what that would do, it would give us negative bullish divergence on treasury bonds. You can see I draw it here. So if we went down a little, I mean, we'd have to come down and take out this low to make it bullish divergence, at least equal that low, which I guess we're already at that right now as I do this video. Did we already equal that? Yeah, we did. Looks like we did. So there's the previous low. So at this point, technically, we do have potential bullish divergence. Now, the indicators are still pointing down. See, the PPO is still angled down. So we need to see a bullish crossover. And, at this point, with prices making an equal low and the indicators making a higher low, RSI, PPO. But again, if you ask what I think will happen, I'm looking maybe just a quick flush out move. It'd be nice to retest those 2015 lows, even undercut them. That would be a bear trap, a little washout move, and then a reversal. And I'm talking a lasting reversal, something you could trade position for. And that would also put in, like I said, very strong bullish divergences. So that's treasury bonds. So I'm near term, let's just say neutral. There's not enough meat on the bone to short it, but I think it might be a bit too early to step in. But keep an eye out. Look for any candlestick reversal patterns or any type of selling climax or anything in treasuries. Anything's possible. Let's take a look at, I didn't mean to do that. Delete that line. Junk bonds. Junk bonds are often a tell for the stock market. Junk bonds are the one class of fixed income, or bonds, if you will, that trade more in line with equities than they do interest rates. Treasuries, high-grade corporates, municipals, those are all more, they trade more dependent on interest rates, whereas junk bonds are more dependent on the economy, the economic cycle, and stock market. You can see here we had a rising wedge, broke down, very impulsive. Now, this is a tell also. The junk bonds have been holding up until recently, and they started moving down impulsively, this breakdown, before the market started rolling over. We also have very powerful, this is all a series of divergence. It's not all drawn out here, but there's also a divergent high like this, one large divergent high. We had a very overbought reading recently, and I see a continued move down to at least this level here, this first horizontal line. That's around 35, 60 or 70 or so, and it could be more than that. So either way, this is a caution flag, or a warning sign, if you will, for the stock market. Very impulsive move down in junk bonds, and in the past, I've used credit spreads and things like that to foreshadow a big drop in the market. And I'm watching that. I don't have it on this chart here, but there are some charts where I can get the credit spreads, which are really the rate differential between junk bonds and high grade or investment grade bonds like treasuries. HYG, that's just another junk bond ETF. You can see the divergences, the overbought reading. Looks very similar. Those two will mirror each other. And I think that's it. Yeah, covered the equity markets, oil, gold, treasuries, and junk bonds. Yep, let's wrap it up here. Okay, guys, that's what I'm looking for. And again, the most important thing is the fireworks are likely not going to begin until tomorrow, despite the little move we have down today. Don't get too excited if you're short, and don't be too exposed to the market unless you're if you're risk adverse. It's not worth it. Anything can happen after a FOMC meeting. If you're an aggressive trader, you can position ahead of that, whichever way you think it's going to go. If you think this market's going to blast off, go to new highs, go ahead and start a long position in your favorite longs, whether it's sectors, individual stocks, or the market, and add to it if you're correct. But I would wait until usually at least into the middle of Thursday's trading session. By the end of the week, that post FOMC noise certainly tomorrow afternoon will be. You'll see some knee-jerk reactions in the market, and then things will you'll probably have a good idea on which way the next direction of the market will be by, let's say, the end of trading Friday or at least early next week. Then you'll have a good clue. All right, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.